You've got equity in your properties, but the bank won't lend anymore. So now what? Most real estate investors in Canada hit this wall eventually. The cash is tight, but the opportunities or the expenses keep coming up. And that's where a participating whole life insurance policy can be a powerful and overlooked solution. Hi, my name is Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial. And in today's video, I'm going to show you how savvy Canadian investors are using a special whole life insurance policy to secure prime lending at Canada's big banks. So they can fund new deals, they can pay for renovations, or they can pay for emergencies without having to sell real estate or having to sell other parts of their portfolio. What is participating whole life insurance and why do real estate investors love it? Participating whole life insurance is a type of permanent life insurance that not only provides lifelong protection, but also builds guaranteed tax-sheltered cash value over time. It's called participating because the policyholder is eligible to receive annual dividends based on the insurance company's profits. So this makes it a unique blend of protection, of savings, and of investment, all rolled into one. For Canadian real estate investors, this strategy is gaining popularity as a wealth building and a capital access tool. And here's what makes it great. Number one is you get the guaranteed death benefit. So your beneficiaries receive a tax-free payout when you pass away, no matter when that is. So you need the insurance. Number two is you get this cash value accumulation. So a portion of every premium you pay goes into a cash value account that grows over time, tax deferred under Canadian tax rules. Third, you get an annual dividend. So participating policies from providers like Canada Life or Manulife or Sun Life or Equitable, they pay dividends that can be reinvested back into the policy, which accelerates your growth. And they've paid these dividends for more than 100 years, every single one of those companies. But really, the key advantage for real estate investors in Canada is this, is you can borrow against the cash value through a policy loan or through a bank line of credit without having to sell another property or without triggering capital gains, or without having to apply for traditional debt. So this means that your policy becomes a liquid, self-collateralized asset that can give you access to tax-efficient capital when you need it the most. So even when you're using the cash, that full value of the policy continues to grow in the background. Now, participating whole life insurance is more than just an estate planning tool. It's a living financial asset that can support real estate growth. It can smooth out your cash flow, and it can serve as a tax-efficient source of working capital. Now, why do Canadian real estate investors love participating whole life insurance? Well, if you are a real estate investor in Canada, you've probably experienced this challenge. Your net worth is great on paper, but most of it is locked up in properties. You want to scale your portfolio, you want to cover a big tax bill, you want to fund a renovation, or you want to seize a time-sensitive opportunity, but the bank says no. Your cash flow is tight, or you don't want to sell off an appreciating asset just to raise capital. And that's where participating whole life insurance becomes a game changer for Canadian real estate investors. This type of insurance creates a tax-sheltered cash value that builds predictably over time, and more importantly, that you can access it while you're alive. It gives you access to liquid capital without having to refinance other properties, without applying for traditional loans, or without having to sell and trigger capital gains. And then here's how investors across Canada are unlocking that cash from their insurance policy. So one way to do it is through what's called a policy loan from the insurance company. So you can borrow directly from the insurance company that you have your policy with using the policy's cash value as collateral. This is one of the most straightforward and flexible ways to access funding. It's super easy. There's no credit check. There's no income verification. There's no fixed repayment schedule. You can repay completely on your terms. Once you submit the forms, the funds arrive quickly, usually within kind of like 3 to 7 days. And then interest is charged, but your policy growth, the cash value, continues to grow in the background. So this strategy is ideal for real estate investors who want private capital access without having the bank scrutiny or without having to go through all that underwriting, without rigid lending criteria, without rigid repayment terms. Because the insurance policy is backing up the loan, your property portfolio and your credit score are untouched because you're borrowing directly from the insurance company. They also don't report to credit. So literally, to get a policy loan from any one of Canada's major life insurance companies, if you've got a cash value policy, it's a one-page form. You fill out the form, you send it in, and if you're getting direct deposit, usually you get that money back within kind of like 3 business days. You can also request them to mail you a check, which this is then going to take like 7 to 10 business days because they're actually printing it and mailing it, and it takes longer. Policy loans are great. Do know that policy loans are non-taxed as long as you're not borrowing more than what's the adjusted cost base. So in the early years of the policy, your adjusted cost base is going to be very high. So you're going to be able to borrow almost all the cash value, usually about 90%, depending on the company. But then your adjusted cost base is going to go down over time. So as it goes down, the amount that you're able to borrow tax-free is going to go down. And that's where you switch. So you could do something like this, the second option that we're going to talk about, which is leveraging from a bank. So banks have their own names for these types of lending. So depending on the bank you go, these are all basically the same thing, just with some changes in the terms, but you could call it an immediate financing arrangement. You can call it cash surrender value lending. If it's an immediate financing arrangement, you often hear it called an IFA. And then when you're doing cash surrender value lending, sometimes it'll be a demand loan. So they'll give you all the money and then you have to pay it all back. Sometimes it'll be a line of credit. So they'll give you access to the money and you don't have to use it all right away. You can take some and not take some. But again, this is where you work with us. We work with all these banks, so we know what types of loans they all have, and we would set you up with the right one to achieve whatever kind of goals you're trying to do. But really, borrowing money from a bank for investors that are looking to maximize their access to capital, I'm just going to use the word immediate financing arrangement to just describe this, or it could be called collateral lending as well. But it's an IFA. So you're using a third-party bank loan that's secured by the policy's cash value. So similar to the policy loan from the insurance company, just the cash value is what's providing the security, but here you're borrowing from a third party. The advantage is you could have higher borrowing limits. Some banks will lend you up to 100% of the policy cash value. Some banks will even lend you 100% of the total premiums that you pay, which may be higher than the cash values. Often you can get interest-only payments, so that really helps with your cash flow. Depending on the bank you use and depending on the type of loan, you can have flexible repayment terms. So some of them might not ask for principal repayment until, one day, eventually you cash out your investments, you pay them out, or eventually, you're probably going to die. And then when you die, the life insurance pays out and it pays out the loan. Interest that's charged on these loans from the banks might be tax deductible if you're using the borrowed funds to earn investment income. Again, this is not going to be me telling you this. This is your accountant telling you this. So talk to your accountant about this. With this strategy, you're essentially turning your life insurance policy into a personal banking system, one that grows uninterrupted and gives you access to leverageable capital on demand. Bottom line is what you can do. You can unlock capital without having to sell a property or without having to to qualify for a new mortgage. Canadian real estate investors love the participating whole life insurance because it solves a major liquidity challenge, which is how to access capital without disrupting your portfolio. So whether you're growing your holdings, whether you're funding a renovation, whether you're covering a tax obligation, whether there's an emergency, you have to fix the roof, this strategy lets you own the permanent life insurance, which you probably need for your business and your family, but then you can also use it as a flexible funding source, whether you're borrowing money from the insurance company directly or whether you're borrowing money from a third-party bank. And this allows you to access that money very tax efficiently and allows you to access it on your terms and allows you to pay it back on your terms. So a lot of advantages. So how does these participating whole life policies work with real estate investing? And I'm going to break it down for you. And this is how some of our clients are using participating whole life insurance to access the capital without selling a property or without applying for traditional bank financing. And this is kind of step by step of how it works. So number one is you need to have a participating whole life policy. So you need to apply for it, be qualified for it, and pay for it. So as the real estate investor, you buy this participating whole life policy from a major Canadian insurance company, and we'll work with you to find out what's the best company for you. Could be, we work a lot with, say, Manulife or Sun Life or Equitable Life or Canada Life. There's a couple ways you can do this. So you can either fund it personally, so you're using your personal after-tax dollars if you don't have a corporation. If you do have a corporation and the corporation has money inside of it, retained earnings or like a surplus, maybe it's a holding company, so then you're using those retained earnings to pay for the premiums. And then those premiums over time will build a guaranteed cash value inside the policy. And then unlike a market-based asset, so unlike investing in the market, this value grows consistently regardless if the markets are going up or down because it's not tied to the stock market. On top of this guaranteed growth, the policy also earns an annual dividend, which can be reinvested, which accelerates your cash value growth. And then another huge advantage of this type of thing is any cash that hits that cash value account is immediately vested, which means that once the cash hits that account, it's immediately guaranteed and it'll never go down unless you're withdrawing it or unless you make it go down. So the cash that hits your account is the premiums that you pay. And then when the policy earns a dividend, that dividend hits the cash value. And then once you set that, that's your new kind of high water level and it'll never go down from there. So that's why banks will lend against it so securely. And that's why real estate investors like it, because it's not like you're borrowing against a portfolio that goes up and down. So the number 2 step, so after you actually get the policy, number 2 is you want to build your cash value over time. So as you fund the policy, the cash value accumulates and it's tax sheltered as it's growing with the dividend. So this becomes your private pool of capital that's accessible at any time for any reason without needing to sell a building or without having to break an investment or without having to apply for another bank loan. So, many of the people that we work with they're investors, you can usually access the cash value technically after 1 year, but we're usually a little bit more conservative. So we're telling people, build it up for a couple of years before you access the cash value. In some cases, if your premium deposits are big enough, you can qualify for an actual immediate financing arrangement, in which case, once we set up the policy, you literally get the loan from the bank the next day after the policy is funded, and we can send proof to the bank. So tons of flexibility when you put the money in. You can borrow the money really soon, as soon as it's set up, or you can wait for a few years and let the cash value really build up. And that's a little bit more conservative, a little bit more traditional, a little safer. Step 3 is that then you want to borrow against the policy. So this is your getting the tax-free capital access, right? So when an opportunity comes up, you want to buy some sort of real estate, whether you're buying it, whether you're renovating it, maybe you're taking over something, or you're lending money to somebody, then you leverage the policy's cash value through a loan. And then, like I was saying before, you get 2 options for this. You get the policy loan, which is borrowing directly from the insurance company. This is the easiest. It's one form. You fill it out, you send it in, you get money within a couple of days. There's no credit check. Nobody asks you what the money's for. You set those repayment terms, so you pay it back quickly, slowly, none now, some later, whatever you want. You borrow from the insurance company. The one thing that you do need to note is that on a year-by-year basis, you need to know what your adjusted cost base is before you take any loans from there, because you don't want your loan to be higher than that, because anything above your adjusted cost base can then become taxable in Canada. The other way you do it is you borrow from a bank. So you do what's called a collateral loan from a third-party bank. So this would be things like an IFA, an IRP, an immediate financing arrangement, an insured retirement plan, cash surrender value. You do cash surrender line of credits. All the different banks have different names for these things, but they're all essentially the same thing. The cash value secures the loan. And then because it's a loan and it's not a withdrawal, you don't trigger any tax from the cash value. And your cash value inside the policy continues to grow as if you've never touched it, because you haven't. It's just used as collateral. Then in the step 4 is you use the loan to invest in whatever you want, right? You invest in your real estate. So now you have this liquid capital and you can invest without having to touch any other property equities. So you can use these loans for whatever you want. So some of our clients are using this for a down payment on a new real estate purchase, or they're using it to pay fees on a new real estate purchase or on renovations. So whether you want to increase the value of the property, so you're renovating it, or maybe you're flipping a place, you might be lending money to other people for real estate. So you're doing private lending because you're able to borrow money in a secured fashion from the bank at a lower rate, and then you're able to lend that out to somebody else at a higher rate. Some of our clients are refinancing a higher rate mortgages, or they're doing bridge financing, short-term bridge financing for some deal that's going on. So the capital is yours to deploy strategically. So you can do whatever you want with it without the limitations of traditional financing. And again, depending on how you've got the loan set up, it may or may not show up on your credit reports. So you might be maxed out on credit in some other places, and then you have this that you're able to go and get money from that doesn't affect your other lending. Step 5 is that you want to grow 2 things. You want to continue to grow your policy cash value, and then you want to continue to grow your property portfolio. And you do these both at the same time. And this is really the beauty of this strategy, is that your money is working in 2 places at once. So inside the life insurance, the policy continues to grow. the cash value continues to grow, the death benefit continues to grow, and all of these are tax-free. Then number two, you've got the real estate portfolio. You've got your investments growing hopefully you make good investments and they're growing. Hopefully they're generating some sort of cash flow or some sort of return. So you've unlocked the capital without triggering capital gains. You didn't have to sell anything. You didn't have to refinance anything. And you didn't have to apply for strict bank underwriting or financing that you may or may not be able to qualify for. And then, at the end of the day, we're talking about this is all underpinned by some insurance. So your family is going to benefit eventually from the guaranteed tax-free death benefit that happens down the line, right? Because one day, probably you're going to pass away. So really, what's the bottom line on here? This lets you multiply your wealth without having to liquidate assets. The strategy gives you, the Canadian real estate investor, a smarter, tax-advantaged way to access capital, to grow your portfolio, and to maintain liquidity while keeping the real estate intact. So it's especially powerful for investors who want to avoid traditional financing or leverage limits, who want to keep growing without selling appreciating assets, who need insurance and they want to integrate their life insurance into a long-term wealth building plan. They don't want to just buy a term insurance that, provides the insurance that you need, but doesn't offer any other advantages. So these permanent policies have all those other advantages, the growing the cash value, the dividend, the tax-free nature, that you can leverage it for the loans to build your portfolio bigger and faster. Now, we also have some tax benefits of participating whole life insurance, especially for Canadian real estate investors. Now, more than just the liquidity and more than just the access to capital, one of the powerful reasons that Canadian investors, especially real estate investors, and especially if you're incorporated, use this participating whole life insurance is the tax advantages that it provides. So now you have to structure these properly, but when you do structure them properly, the strategy creates multiple layers of tax efficiency, both during the lifetime and as part of your long-term estate and your succession plan. So let me break this down into a couple parts. Number one is you get the tax-deferred growth on the cash value that's inside the policy, right? The cash value that's inside your whole life insurance policy grows tax-deferred, very similar to an RRSP or a TFSA. So there's no tax every year as this thing grows. So you don't pay tax annually on the dividends or on any interest earned. The cash value compounds uninterrupted over time as long as you're not withdrawing it, right? So the huge advantage of compounding is when you can do it over a long period of time. You get this hockey stick curve. And the problem is most people never get to that break point on the curve where they can let the compounding really take off. There's no reporting and there's no drag from a taxable investment income perspective. So this is especially valuable for any investor who's already maxed out registered accounts. So your RRSP is full, your TFSA is full, and you're looking for somewhere else that you can make money without having to pay a ton of tax. Secondly, is you get the tax-free access to the capital through either the policy loans or the collateral loans. So when you're borrowing against the policy, again, through a policy loan from the insurance company or from a third-party loan through a bank, like an immediate financing arrangement, those funds are not considered taxable income because they're loans, they're not income, and they're not withdrawals. So this means that you get the liquidity without having to sell real estate, without having to trigger capital gains somewhere else. You maintain control over your assets, and then you avoid bumping up your taxable income in a high tax bracket because you're borrowing the money, you're not paying yourself an income. So this tax-free access to capital gives your real estate investor a strategic edge, basically, right? Especially during years with big sales, or you've got a big renovation project, or you've got a big market opportunity. You're able to take advantage of these because you've got this guaranteed access to cash. And then third, and this is a big part of the value of the insurance, is you get the tax-free death benefit for your estate or for your corporation. So if your real estate's held in some sort of corporation or in a trust, the death benefit from the participating policy pays out tax-free to the beneficiary, which could be the trust, it could be your corporation, it could be your family. And then this means that the family, your family ideally, receives a guaranteed tax-free payout. Your corporation can use that death benefit to create what's called a capital dividend account or a CDA. And then you can transfer this wealth efficiently without having to go through probate, without triggering capital gains, without having to pay income tax. If the policy is corporately owned, the death benefit minus the adjusted cost base of the policy gets credited to CDA. So this lets your estate or any surviving shareholders of the company, resident Canadian surviving shareholders of the company, to take that money out of the corporation tax-free, which is a hugely powerful tool for your estate plan, for your succession plan, for your legacy, and for building generational wealth, which is, something that's super important to a lot of our clients when they come to us. Having that, being able to pass that down to their kids is something that's super important. And then fourth is you could deduct the interest. Now, again, I'm not an accountant and I'm not giving you tax advice here. So when you're borrowing against your policy and you're using that money to generate income, so you're buying a rental property or you're investing in a private lending deal or you're funding a business, you could deduct the interest, right? So when you're borrowing to invest, the Income Tax Act lets you deduct the interest. And again, I'm not giving you tax advice. Your accountant will tell you this, but it means you're earning returns from the investment, you're growing the policy's cash value, and you can write off some of the loan interest to reduce your taxable income. And this is a tax strategy that a lot of Canada's most tax-savvy investors will use to multiply their capital efficiency and to build long-term wealth and to build really long-term wealth for generations for their family. Now, who should use participating whole life insurance for real estate investing? Right? So participating insurance is not just a protection tool, so it's the insurance part. It's a powerful, tax-efficient financial asset that can unlock the capital. It can preserve your wealth. It can provide strategic leverage when you need it. But like any sophisticated planning strategy, it works best for those who meet the financial and investment criteria. It's not for everybody. This strategy is really well suited if you're a Canadian real estate investor, especially if you're incorporated or you're owning the real estate in some sort of entity like a holding company or a trust. So number one is you own or you're building a real estate portfolio. You probably have multiple properties or you're actively growing this portfolio. So this strategy helps you to unlock liquidity without relying solely on a traditional type of bank financing. Also, instead of selling a property or restructuring your mortgages, you can borrow against your policy's cash values so that you can access capital. And you're going to access this capital for a down payment on a new property, or for renovations, or for like a value add or improvements, for bridging financing. So you can have a short-term finance gap. Maybe you're doing private lending. You've got some passive income opportunities, or just fees and expenses that come up. It's property tax time, or you bought a place and there's $50,000 in fees just to end up buying this thing. So this makes the whole life insurance kind of like a private banking solution. And you'll actually see this on a ton of videos online. On YouTube especially, there's a lot of people that kind of promote this in the US, and they use that banking term. It's infinite banking or cash flow banking, or one guy has a BRRRR banking, which is actually kind of a cool concept. Those are all in the US, so you can't really work with those people because they're not allowed to work with you in Canada, and that's what we do. But really what you're doing is you're using the policy as collateral to get loans so that you can use that money to expand your portfolio. Number two is if you've got retained earnings inside a holding company or inside your corporation. So if your real estate portfolio or your business is structured inside of what they call a CCPC, a Canadian Controlled Private Corporation, then hopefully you've got retained earnings. You've got corporate profits inside the company. That would be taxed high if you pulled it out personally as income. So by having this corporately owned participating policy, you can grow tax sheltered inside the holding company, right? You're growing the money, you're growing this cash value. You can access the money or the funds through either the policy loans from the insurance company or a collateral loan from a third-party bank. And then you could trigger a capital dividend account credit, so a CDA credit, when you or when a major shareholder who's insured dies, which allows this tax-free wealth transfer to the beneficiaries or to the remaining shareholders. So this can turn your retained earnings from the corporation into a financial engine that'll support your real estate goals today and your family's estate goals tomorrow. And then three, you might have already maxed out your registered accounts, your RRSPs, your TFSAs. So, many high-income Canadians quickly outgrow the contribution limits of RRSPs or TFSAs. So having this type of participating whole life insurance, this is a third bucket, a third tax advantage bucket where you can grow wealth, because the cash value accumulates without tax as long as you're not withdrawing it. And there's no contribution limits. It's whatever we can apply for and get approved for with the insurance company. Then the death benefit pays tax-free to the corporation, which will create or increase the CDA. which can then go to the beneficiaries or your estate in a tax-free way. And then you also don't lose the contribution room from those other accounts, your RSPs, your TFSAs. So if you have them maxed out, well, it'll go up next year. So you can continue to contribute to those, and this type of cash value life insurance policy isn't going to affect it. So it's a smart next step for long-term planning, for long-term wealth, for retirement, for estate. And then 4, it's when you want access to capital without having to refinance something else, or without having to rewrite your mortgage, or without having to sell a property, right? So refinancing in today's market is more risky than it used to be. Interest rates are higher, lending criteria is tougher, longer approval timelines. So with the participating insurance, we can bypass all of this directly. So whether you're borrowing directly from the insurance company, you skip the bank, or, and again, you're borrowing from the insurance company, there's no credit check, there's no income verification, there's no disruption on any of your real estate holdings. It's fast, it's super flexible, and it preserves the cash flow in your portfolio, and it preserves the cash inside your policy. Now, if you are borrowing from the bank, again, you have all those advantages. You get usually preferred rates. So many of our clients, when we're doing this kind of stuff, they're getting rates at prime, maybe prime plus 0.25, prime plus 5. But even we have some clients getting prime minus. It really depends on kind of the volume of lending that you're doing. And then it's fast. So at the beginning, when we're actually setting up the policy, so when we're getting you applied for the insurance and we're getting you qualified for the insurance and you're paying for the insurance, at the same time we're doing that, we're also talking to the bank and getting your lending set up against this policy. So at the beginning, sure, it can take some time, some weeks or some months to get it set up. But then once it is set up, it's done. And then next year, when you want to increase your loan with the bank, you just show them that you paid your policy premium. You show them what all the values are. They'll increase that. So if an opportunity comes up, you can act on it quickly because you have this line of credit that's already set up at the bank. You don't need to go apply for it. You don't need to do anything. You already have it. So you can just get the money. You can get the money today. Number 5 is, this is great for people who are focused on long-term and tax-efficient wealth building. So this strategy is for sure not for short-term speculation. If you're planning on using one of these policies for a year or 2 or 3, don't do it. This is not a good idea. This is for disciplined investors who want to grow and protect wealth for decades. So we're not setting up these policies for you and then canceling them. I don't want to do that. It's a huge pain in the ass, and you're defeating a lot of the purpose and a lot of the reasons for setting these things up. So we definitely are setting this thing up for a long term, and we're not looking at 1 or 2 or 3 or 4 or 5 years of having these policies. We're looking at 10, 20, 30, 40, 50 years of having these policies. So this is whether you're preparing for retirement, whether you're thinking about building intergenerational wealth, whether you're thinking of protecting your business legacy. These types of insurance policies, they have the tax-deferred growth on the cash value inside. They have the tax-free liquidity when you're borrowing the money, either from the insurance company or the bank. And then they have that tax-free estate transfer through the capital dividend accounts, which can flow your legacy to your next generation in a tax-free way. And then when you combine this with your real estate portfolio, this is a super resilient, a super tax-efficient financial ecosystem that now supports your goals today and in the future, and lets you keep the portfolio together, especially from an estate planning perspective, because you have, when you pass away, there's going to be this deemed disposition on death. So all of those properties are going to become taxable. And how's your family going to pay those taxes? Do they have the cash? Probably not. So this insurance payout provides a huge chunk of cash right then, that you then take that cash, pay the taxes, and then your family keeps the rest. Or, if you don't like your family, then other beneficiaries would keep the rest. But what's the catch, right? These are important caveats that you definitely want to have. So number 1, this is a participating whole life policy. It's a powerful financial strategy, but it's not a silver bullet. Like any long-term wealth building vehicle, it comes with important considerations that you definitely should understand before you commit. So number 1, this is not a get rich quick kind of thing. It's not a short-term thing. It's not a short-term fix for any liquidity problems that you have. This is a long-term tax-efficient wealth building strategy that works best when it's integrated into a disciplined financial plan over years and decades. This is not designed for quick flips. These types of policies are structured to build value slowly and steadily over time. In the early years, the cash value doesn't build as fast. The way that we structure them, we can make a lot of cash value right away. Usually in year one, it'd be like 80, 90%. And this is, again, where we stand out from other advisors that can set these policies up. Some of these policies, if you set them up not the way that we do, they might not have any cash value for like 10 years, which is then you can't do any of the stuff I just said. But the way that we structure these things, you can get whatever premium you pay, almost all of that, usually in year one. And usually you're breaking even by the premiums you've paid versus the cash value that you have access to in like year 3 or 4, sometimes year 5. But really it's a few years, and we're thinking in years and decades here. And you want to build this thing up as big so that you can have this accessible equity that's inside the policy. And if you're looking to do some sort of weird flip in 6 months, or you need instant cash right now for this is probably not the right tool for you. This is not a get rich quick, a quick flip kind of thing. This is for the long game, where that policy growth, the tax deferred compounding, the access to capital becomes more valuable over time. Like, these policies are better later. Funding this premium requires commitment. So to make the strategy work, you need to be financially comfortable. You need to be consistently funding these premiums, usually for like at least 10 years, ideally longer. So oftentimes it's 20 years, or sometimes people fund these things for like 40, 50 years. It really depends on how we set up the contract and what you're trying to do and what is your cash situation, your cash flow situation. You're going to be contributing thousands of dollars per year, which is either personally or corporately. If you're doing the borrowing from a bank, the minimum annual contributions on this is going to be around $100,000. Some banks won't look at lending on these policies unless you're doing at least a $300,000 a year annual premium. And again, we have clients putting in all sorts of numbers, anywhere from $100,000 a year. We got tons of those, 200, 250, 500, 700, 900s. Our biggest client right now is putting a $5 million a year and has been doing this for some years now and is expected to continue to do this over time. So the range is very high. Do be careful of anybody who's trying to tell you that you can do something like this for like a few $100s a month. You can't. None of what I've talked about works like that. Your minimum to do what I've talked about is, I would like 50 grand a year would be the lowest, but really 100 is kind of where you comfortably want to be. You definitely want to know that the premiums are not tax deductible. Don't deduct your insurance premiums. Bad idea. Canceling the policy early, like within the first couple of years, is going to have a reduced cash value. So if you want to guaranteed lose money, set up one of these policies, pay the premium, and then cancel the policy. You're going to guaranteed lose money. And if that's what you want to do, then go nuts. Actually, don't do it with us. We don't want to participate in that. That being said, it's not lost money, right? The premiums are funding the insurance. The premiums are funding the cash value, which grows in a tax-deferred ways, and then that you can leverage against. So you're either doing it with the insurance company themselves or you're doing it with the bank. And again, patience will pay. So this cash value can build over time. One of the biggest benefits of this type of whole life insurance is the predictable, guaranteed growth of the cash value, plus the dividends that come from the insurance company's participating account. So these benefits compound over time. So you got to be patient and you got to let the value build, right? And obviously you're a real estate investor. You understand long-term growth. You understand long-term appreciation. We leverage this kind of parallel, which is that like how the real estate appreciates and generates the equity over time, your whole life insurance policy appreciates and builds up equity over time. Now, something you definitely need to know is that not all whole life policies are created equal. This is probably the biggest one. There's a huge wide spectrum of how to structure a whole life policy and how to set it up in Canada. And not all of them are well suited for cash accumulation. Not all of them are well suited for borrowing, and not all of them are set up in such a way for a good real estate strategy. So we exclusively work with high quality participating whole life policies from Canada's top insurance companies, and we have very good relationships with them. We talk to them all the time and we work with them all the time. The companies that we work with the most, Manulife, Sun Life, Equitable Life, Canada Life, Industrial Alliance, these all have really good whole life insurance contracts that work for what we're talking about today. They have strong historical dividend performance. They have competitive loan to value ratios. So when you put cash into these policies, whether you're borrowing from the insurance company directly or from a bank, you can borrow up to 90% of whatever the cash value is, which is huge. You're like a 90% LTV is really big in real estate. You got really flexible funding options, especially after you've paid into these contracts for a couple of years. And you've got really, really good, reliable contract structures for whether you're borrowing corporately or personally with the bank. So the bank recognizes these insurance companies as having good whole life policies that they want to lend against. So if you're working with the wrong contract or the wrong insurance company or the wrong advisor, you might end up with a policy that doesn't accumulate that cash value quickly enough. Or you set it up in such a way that it doesn't qualify to be leveraged at the bank, or it doesn't build up big enough to make any sort of worthwhile dent in your real estate goals. Or you set it up in such a way that the death benefit isn't going to be big enough in the future when you need it for the estate planning reasons to pass the money generationally to your family. So you definitely want to work with the right team because the strategy and the structure matters. It matters a lot. It's not just about buying whatever insurance policy. It's about building this strategic financial asset that can integrate with your tax planning, with your real estate portfolio, and with your long-term goals. So this is what we do. This is what makes us stand out in the crowd of people who can sell you these kind of things. We will coordinate with your accountant. We will help you to structure how the ownership is set up. We'll help you set up the leverage, whether that's from the insurance company or from a bank. We'll help you to make sure that you have all the numbers from the policy so that you can report your taxes properly. We will work with whoever's doing your lending, whether that's a mortgage broker or a banker. If we're setting up any sort of structured or secured lending against the policy, say you're setting up this cash surrender value lending or these lines of credits or an IFA, we work with your lawyer to make sure that the policy aligns with your estate plan, to make sure that it's set up in the right way with your holding company, or maybe you don't have a holding company yet and that's something that you're working on doing. So this is like where we add a tremendous amount of value outside of just setting up the policy. Because when done correctly, a participating whole life insurance policy really can help you to access this tax-free capital. It can help you to build a long-term wealth. It can help you to transfer your estate efficiently, all while your real estate portfolio continues to grow. And also while you don't have to sell the real estate in order to fund the future, right? You're using this insurance policy as collateral so that you can fund the future. But really to get everything that I've talked about today, to get these results, you need the right policy, you need the right structure, and you need the right long-term mindset, and you need to be working with the right team that knows how to do this, because most insurance advisors in Canada have no idea how to do what I was just talking about. You know, obviously they understand that you have some sort of whole life policy, but how do you structure it? How do you set it all up? Where do you put it? How do you send it to the bank? What numbers does everybody need? Like just knowing how to do all that is what most people don't have. And this is what we do all day, every day. Now, this video is getting a little long, so let me wrap it up on how you're going to build, borrow, grow without the bank telling you no, right? These whole life insurances, it's not just about the death benefit, although that is an important part. This is a smart, flexible asset that real estate investors across Canada use to unlock capital. They use it to fund new opportunities and they use it to grow their portfolio on their own terms. So if you're tired of hitting that borrowing limit, or you're jumping through more bank hoops just to get another mortgage, or you're watching that your liquidity sit idle, I would suggest that you look at what your policy's cash value could do, or you talk to somebody about seeing what these numbers look like for you. This strategy can put you back in control and give you access to tax-efficient capital without having to sell properties or without having to take on restrictive debt. So now if you want to see how do these numbers fit for you, like what kind of cash value we can generate for you, and then also what kind of death benefit that we can set up for your real estate plan and your actual eventual estate plan. So if passing this on as a legacy and a generational wealth thing is important for you, how do we do that? Talk to us. We're happy to meet. We'll set up what's called a discovery meeting. It's our first meeting. And the way that you do that, you go to our website. It's safepacific.com. On our website there, you'll see there's tons of buttons where you can either book directly in our calendar, you can set up a meeting time, or you can send us a message through the contact page and somebody will reply to you, answer any questions, or set up a meeting time. But it's on safepacific.com. I'm also going to include a link either somewhere around this video, or it's going to be in the description where you can just do that directly. We'll set up a meeting time and see if we're a good fit to work for you. See if this strategy even makes sense for you. This is only something that some people should do. It's not something that everybody should do. But if you are a real estate investor and you're looking to grow to that next level, this can be a super beneficial way to grow your leverage and to grow your collateral so that you can buy more properties. That's going to be it for me today. But before we go, if this video gave you any value, please click all the buttons, tell the algorithm, tell the robots, tell the AIs that you liked this video. So that is hit the like button, hit the subscribe button, leave a comment. Engagement is actually one of the best things to help these things spread. So even if you don't know what to comment, just comment what city you're watching from today. You don't even have to ask a crazy question. Just put a hello or put I'm in Regina. Any of that kind of stuff helps with the engagement and it'll help it spread to more real estate investors in Canada who are having a hard time right now. The real estate game in Canada is a little tough, but hopefully we can help to make it better. That is it for me today. I'll see you next time.